Speaking of the bank Nifty, over the weekend, we had more policy action from the RBI, and they've gone ahead to ease some rules, some norms for small finance banks. Now, the norms in question are the priority sector lending norms, which is where the earlier requirement of 75% has been now dialed down to about 60%. So what does this mean for companies? Let's talk about this with Mr. Ajay Kanwal, Managing Director and CEO at Jana Small Finance Bank. Mr. Kanwal, thanks so much for joining us this morning. So that's really our first question. No longer a mandate to do 75%, now 60%. So what does this additional flexibility mean for small finance banks, including Jana?
Right. So good morning to you and all the viewers. It has been a long request from the Association of Small Finance Banks to see if the norms could be dropped from 75% lower. So I think the 60% is very welcome, and a big thank you to our regulator. What it does do is it allows us to do different kinds of things. So for example, car loans, lending to small corporates, which is probably beyond the turnover levels of MSMEs, two-wheeler loans. So there are many categories of loans which don't fall under priority sector. I think this allows us to do more of that. And it also fits very well into what is known as a diversification of asset book. So if any SFB did think that, his diversification strategy was being hurt by the high PSL number, then certainly now better opportunity to be more diversified. So those are three things that I could mention.
Hi, sir. Good morning and good to see you in. So you have the liberty now to lend to other sectors as well. So could you tell us how do you see things panning out this, how do you see your loan book mix changing? Point number one. And point number two is it'll affect your margin profile, right? It'll be accretive. How do you see that pan out?
Right. So first is for Jana specifically. Listen, we are already 70% non-microfinance. And we have been in the affordable housing, business lab, MSME from the last 7 years. So for us, it's a good tailwind to have, but doesn't change any strategy, obviously, immediately. It does help us as we go up into supply chain, into lending to small size, mid-sized companies. Then we certainly have an advantage with this coming in. So that's what will happen within Jana's context. But as you very well know, all SFBs have different asset class diversifications and sizes. So I'm sure others will take bigger benefit of it. We'll probably take a smaller benefit of. But I think it's a very welcome answer for us.
Mr. Kanwal, in our earlier conversations, you've always spoken about how Jana is looking to increase the share of secured lending. So just revisit that whole plan for us, and now with a very different requirement on priority sector lending, say a year down the line, what would be your targeted book look like? I mean, how much would it be, maybe auto finance, and how much? Just trying to understand, say 1 to 2 years down the line with this new regulation and your move towards secured, what will the book look like?
So first is, this regulation is also signaling to us more diversification is better, and that supports us quite a lot. We certainly would like to reach 80%, and that is what we have said in the public domain also. We've reached 70% in the last 7 years. We would certainly like to reach 80%. In the balance 20%, of which is largely microfinance business, we would like to put that all under the guarantee program of both CGMFU and CGTMBC. So in a way, you can say that, we'll be secured 80%, but fundamentally my entire book will more or less be either under guarantee program or a secured book. So that will be a combination in the next two to 3 years at best, depending on how the different things work out. I missed answering Prashant's second part of the question, so I suddenly remembered. See, on the margins, yes, as you do secured, margins will be lower, no doubt about it. Yeah. There is a compensating answer when it comes to cost income. So your cost income for secured assets is better. And second, your gross NPS will be better. Yes. So starting wise, small compression in NIMs, we have lived through that in Jana. We were at 10.5, 11% NIMs when we were all unsecured. We're down to 7.7. But then our cost income has shown a big change. And I do think that even if you look at this whole stress in the last 1 year in MFI, we've been slightly more removed from it because the book composition is low there. So it certainly helps in cross NPA and cross income.
What's the AUM growth target this year? Now that you have this slight relief also from RBI, you can look at other segments.
So I must say that 2-3 things have happened very brilliantly in the last few months, probably signaling what to expect. I think the repo rate cut, the CRR cut, a very clear cut, helpful gold loan circular, now the 60%. I think towards the trend is very clear that things are getting easier as we go along. We have signaled a 20% growth in asset, and as of now, we were not changing that. But rest assured that yes, every endeavor that if you could do more.
Okay, so perhaps more than 20% growth of the book this year, given the favorable environment. Got that. Thank you very much for joining us. Short conversation today, but it's a helpful one. Thank you very much.